Greetings, this is Manu Walia from Continuum Global Asset Management on October 8th, bringing you the market commentary and the current issues and topics that we feel are important in the market. Well, today's topic of discussion is the currency devaluation and the focus on currencies from not only the emerging countries but also industrialized nations as the US and parts of Europe. Before we start talking about currencies, I would like to just talk a little bit about what capitalism is and what I believe capitalism does for the world. The importance of capitalism is to provide a better standard of living for all the participants involved in that particular region or that market or what have you. So when we start talking about opening borders and making this a global society where we do trade and we benefit from that, what does that really mean? What that means for industrializing or emerging countries is that the disposable income of people on an average goes higher so that they can feed their children better. They can provide a good shelter and clothing for their kids and themselves and start to enjoy some of the amenities which are desires as opposed to needs. Great. That's always good. To have an AC when there's temperature of 110 outside is great. To have a car to take you from point A to point B is great. To watch news not only on TV but the internet, that's great. It adds to the standard of living. But I do believe, and this is a very important point, I do believe that what capitalism does and is based on is to incentivize people and consumers to keep consuming more. I'll give you an example. When the iPod came out, I don't know, 7 or 8 years ago, we had a little mini iPod for $169, and it was black and white screen, and all it could do is put songs and you can listen to songs. Great. The next year it was a little bit better. The following year there was a better iPod. Then it came with an iTouch, so on and so forth. So the bottom line is the same, but we keep spending more and more money for our desires. In other words, to keep up with the Joneses. So the society has a deep-rooted incentive to continue to create a consumption behavior for all the participants in society. Having said that, the emerging countries are benefiting from this behavior in the industrialized nations like the US and parts of Western Europe. Between the two regions, the economy is about 25 to 26 trillion dollars, or about 40% of the global GDP. So obviously countries like China, India, Brazil, Japan, some of the other emerging markets have an incentive to export to these major nations, which I call the community of consumerism or consumed, the society which is consumed with just consuming. We're a net consuming society. We buy more than we create. So how long can that last? Well, on one hand, you've got China, India, Brazil, Russia, Japan trying to devalue their currency compared to the US dollar and euro so that they can export, and there is an incentive for the US and Europe to buy more. But what happens if the US and Europe do not continue to create or maintain the value of their currencies? Well, we all know that major commodities like oil and some of the other major commodities that are used for manufacturing are denominated in the dollar. In other words, if China wants to go out and buy gas in the international markets, they have to buy it via the dollar. They have to use dollar. Now, what they're trying to do is they're trying to artificially maintain a level between the yuan and the dollar. Great. I mean, that's great because, this is capitalism. They have the competitive advantage and they keep adding value to products, or I'm sorry, raw material, and sending it to the US so US keeps consuming. At some point in time, their reserves, which they already have about $3 trillion of reserves, continue to make higher highs, continue to go into a bubble. Well, they're not saying that this is a bubble. They're saying we have to maintain a certain level of the yuan. Fine. The yuan is about 660 or 650 something at this point to the dollar, which is a reasonable value for the Chinese. But what happens eventually when their surplus in dollar terms or euro terms continue to go into a bubble range, they have to go out in the market and buy those commodities which are denominated in the dollar. The Saudis or the oil producing countries will say, hey, we need to raise the price of this commodity because when we go out and buy things in the dollar terms, we don't have enough value because the dollar is not holding its value because the US is not creating enough value into their society for the dollar to hold its value. So what's going to happen is instead of letting the markets devalue or appreciate a currency depending upon the GDP, artificial ways will create a bubble which will implode eventually, just like the housing market or the dot-com bust imploded or exploded, whichever term you want to use. So I think that we as a government cannot and should not go to a China or an India and say, "Hey, you've got to let your currency float." Let them learn their own lesson because we can only write so many IOUs to them. So we will have to learn from our problems of just being a net consumer and not adding enough value. And China will have to learn from their own mistakes that they're making by just allowing the US to consume and getting their IOUs and continue to buying the treasury. Now, this might sound a lot convoluted, but in other words, what I'm saying, the bottom line is if you are a participant of a capitalistic society, and I'm not talking about one country, I'm just talking about the concept of capitalism, then you've got to play by the rules. And the rules are let the chips fall where they may. In other words, let the currencies go with the free float so that you don't get into the bubble situation eventually and have a real deceleration of an economy, of a currency, or a region. Well, I believe that eventually we may head towards having one currency for the entire globe. Now, it may take 100 years to do that. I don't know. But just like the Europe did it, we are a capitalistic society. And I'm not talking about just the United States. Most regions in the world have opened their economies and are benefiting. I'm talking about their basic standard of living. The standard of living in most regions which are economically open have gone up. There's no debate about that. But how these countries look at capitalism is a little bit different. China may be different than India. You know, India is a democratic state. China may not be. But all of these things will come into fruition. Having said that, we're going to go back to our concept, which is sort of, we sound like a broken record, but we've been saying it. Globally, we believe that emerging markets for the next 5 to 10 years are going to do much, much better than the United States because the United States seems to be going into a more protectionist mode, and China and India, Brazil, Russia, these are the countries that are sort of opening their economies. And unless and until they do more and more domestic consumption, they're not going to be able to sustain just as an export-oriented economy. So we would be more than happy to talk in details about this concept and give you specifics as far as investing is concerned. Feel free to contact us through our website, which is www.cgamadvisor.com. Again, that's www.cgamadvisor.com. Thanks for listening and happy trading.